Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Ray, Senior Investment Strategist in our bank's Chief Investments Office. A very warm welcome to this new episode of Through the Noise. And today I'm very happy to be joined by Manpreet, our CIO for Africa, Middle East and Europe. Hi Manpreet, let me just go straight to the first question. On the performance of the financial market, now if we look at year to date, the market has been quite volatile. If I ask you, as an investor, should we be worried at the moment?
Hi, Ray. Thanks for having me on. It has indeed been quite a wobbly start. I was looking at it in a few different ways. But if you just look at markets in the first quarter of 2025, US equities, of course, have been through about a 10% peak to trough correction and underperformed other major regions. We've seen the 10-year bond yield dipping by over 60 basis points. At one point, bonds, of course, have been outperforming global equities. So we've been asking ourselves the same question about whether there's something to worry about, whether this dip in equities is actually worth buying. Now, I think some of the underlying macro trends can really help provide a bit more clarity on how investors can respond here. If we look at the US, which is really the center of the attention at the moment, you can see that a growth scare or even a stagflation scare is visible in select data. So I take the example of the high frequency Atlanta Fed GDP Now indicator. We saw that drop sharply into negative growth territory in February. And at the same time, we did see the University of Michigan's 5-year inflation expectations indicator spike to the highest since the early 1990s. So if I pick these two data points alone, and you sort of add to that heightened uncertainty ahead of the 2nd April US tariff announcement, it helps understand why markets have been a little bit volatile. But these are just two data points. And I think more broadly, we're reluctant to get too negative. If I look at a more broader sweep of data, that's actually much more supportive of growth and risky assets. So to cite another few examples there, the US lead economic indicator, while still negative, it's actually recovering from last year's lows. The job market also appears resilient in the face of what have been US government cost-cutting fears. And the Atlanta GDP Now number we just talked about is most probably explained by one-off factors, particularly front-running of imports, ahead of tariff announcements. So while we'd acknowledge that tariff policy announcements warrant a modest recalibration and keeping a close watch on high-frequency data, but as a central scenario, we're still positive on growth and not really that worried about recession.
That's very good to hear. We are still talking about a growth scenario. But obviously, volatility has increased. And again, this context, are you still constructive on equity markets broadly?
We are. And I think the positive tilt on some of the macro drivers is why we're holding on to our preference for global equities over bonds and cash. Now, what we have done, though, is trim the size of that overweight in equities modestly in response to some of the uncertainty we discussed on tariff policy and still elevated inflation. But having said that, despite that trimming of the overweight, a possible avoidance of U.S. recession means we still see room for global equities to rebound once we pass the policy uncertainty event risk on 2nd of April. Now, that said, while we're maintaining that overweight at sort of a broad asset class level, we are narrowing our regional focus. So one key question has been whether to chase the recent outperformance of European equities relative to the US. In our view, the parliamentary approval of Germany's fiscal spending package is a step in the right direction and supports the domestic growth outlook. However, that's not the same as a euro area-wide removal of debt limits. The other factor is that the US dollar has not yet broken lower, and the speed of the rally we've seen in European equities does leave investor positioning a little bit stretched, a little bit too much so to be adding aggressively at this time. So on balance, where that leaves us is that we're holding a balanced view between US and European equities, now viewing both as core holdings. The other debate from a regional perspective, of course, was between Chinese and Indian equities within Asia. Today, we believe Chinese equities can continue to outperform their Indian peers, and we favor particularly offshore Chinese equities over their onshore peers. And look, while China's equity rally was initially led by the sentiment boost from low-cost AI chatbot DeepSeek and what were inexpensive valuations, a follow-through in parts of the earnings outlook means that we think the rally does have legs for now. Now, this does not take away from a constructive structural view on Indian equities. Indeed, more moderate valuations here means that we see it as an attractive buy on dips candidate. But for the time being, we expect gains to lag those of Chinese equity markets.
Thank you, Manpreet. So we touch on the macro view and we also touch on a bit on equities. How these two impacting our views on bonds right now?
Well, one link is that, look, we're constructive on growth. So what that means is that we hold a modest preference for corporate bonds over government bonds. So, more growth-sensitive bonds as opposed to rate-sensitive bonds. Now, this stance is not new when it comes to a preference for high-yield bonds. We have been overweight and we're continuing that. And you can see that muted default pressures across regions are one key reason why we're comfortable maintaining that overweight and high yield relative to investment-grade peers. And the bigger point here, of course, is that we favor exposure to growth-sensitive bonds, so corporate credit, high yield, as opposed to interest rate-sensitive bonds, such as investment-grade government bonds in the macro environment we expect. But within developed market investment-grade bonds, that's really where that preference for corporate bonds over government bonds becomes more real. Both do provide quite a bit of sensitivity to changes in government bond yields and interest rates, but we do believe risk-reward favors a slight tilt towards more growth-exposed and slightly high-yielding corporate bonds. We also close our prior underweight on emerging market local currency bonds, given they have performed well recently, and our expectations that the US dollar will remain range-bound from here.
I see. A stellar performance in gold, insofar in particular, and we are reaching and actually overshooting 3,000 per ounce right now. Is it time to take profit?
It's tempting to discuss the possibility, but in our view, very little has changed on the fundamental case for gold, even after its break above $3,000. At the end of the day, central banks remain avid buyers, and particularly in the context of heightened U.S. policy uncertainty, adding to that supportive case. The other factors, when you think about some of the macro risks we discussed, we see the precious metal as one potential hedge against any rise in either inflationary risks or stagflationary risks. What I will acknowledge is that the speed of the rise recently does mean that short-term positioning is now quite stretched. So a short-term pullback or correction of some sort would be reasonable, but we'd expect any such pullback to be quite modest. And given the positive fundamental backdrop, any such dip is one we'd be very happy to buy in gold.
Okay, I think we need to for sure wrap up with a question on dollar. It doesn't seem to have broken out of the range in the last few years. Is that going to be continuing in your view?
What's most interesting about the US dollar, at least when we look at it through the lens of the DXY dollar index, is that despite the uptick in recession or stagflation worries, the dollar index has remained very firmly within its 100 to 110 range that it's been in since 2022. So over the next 1 to 3 months, we do expect the dollar to rise within this range towards 106 as markets consider the implications, particularly of tariffs and what they mean for inflation. But longer term, we're still expecting the dollar index to stay range bound in the absence of any clear catalyst to break either above or below this 100 to 110 range.
I see. Thank you, Manpreet. So I say we shall actually stay invested and maintain a balanced portfolio to ride through this volatility. And that's all the time we have for today. Thank you all for listening to this episode of Through the Noise. Stay tuned for our next episode. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.